Okay traders, welcome back to the Price Action Labs YouTube channel. So in this video, we're going to be going over how to swing trade gold or any market using three important principles. Power of three, how to choose your POIs, and how to combine everything with order flow so you stay on the right side of the market. Now with that being said, let's dive into it. So the first thing to understand is that there's four things you need as a market trader, especially as a swing trader, right? The first of those is going to be your market structure, right? Market structure simply refers to highs and lows, right? So if we just kind of replay price back a little bit, what you need to understand is where the market actually breaks structure, right? This is the most important thing. So now that we've had a break of structure just over here, notice how this is not a break of structure, this is not a break of structure, this is the break of structure because it occurs with a body closure. Body closures are very important for higher time frame breaks of market structure. Now with that being said, that is step number one. Step number two is you need to identify your dealing range. So what do we mean by a dealing range, right? Dealing range or DRT, right? I just call it a dealing range. Dealing range refers to the most recent swing high and the most recent swing low in the structural range. So this is the recent structural high and this is the recent structural low. Now with that being said, how can we use this to our advantage, right? How can we use this for swing trading opportunities, right? So swing trading is about mastering the market structure and knowing where to sell from in this case and where to buy from afterwards. So it's all about understanding premium and discount, and that is the third step. Premium and discount is very important, again very misunderstood, so my job is to simplify it for you, right? So as a New York trader, as a London trader, right, it doesn't matter what session you trade or which part of the world you are, whether you're Singapore, Australia, Canada, New York, even Antarctica, right? You need to understand that you're trading premium and discount and higher time frame fair value gap. So the kill zones or the time zones matter a lot less. So this is our overall dealing range, and our premium and discount is simply projected from the swing high down to the swing low, right? This is gold on the 4-hour time frame. And so from here, what we can understand is our final step is basically going to be fair value gap. And we actually pair fair value gap with liquidity, right? But fair value gap is the most important concept. And so how can we use this to our advantage, right? So we have a ton of liquidity resting over here. This is trendline liquidity or internal range liquidity. The reason we call this internal range liquidity is because it is inside of the dealing range high and the dealing range low. And so how do we choose our fair value gap, and how is a fair value gap different to a point of interest? Because they're two different things. And so a fair value gap, I'm going to mark out for people because I want traders to understand this, right? This is going to be your fair value gap. And so a fair value gap is basically an inefficiency in price. So I'm just going to label this as a fair value gap over here, just so traders can understand. This is our fair value gap in blue. So how does a fair value gap differ from a POI? So a POI is basically a point of interest, right? The reason a POI is so important is because you want to understand where to target and where to trade from, right? This will tell you where to target and where to trade from, which is exactly what you need as a swing trader. So if you're a swing trader who doesn't know where to hold their trades, where to hold up to, or where to sell down to, or where to actually sell in the first place, this is going to answer your questions. And so this is our POI. So if I just kind of drag this over to the right, your POI is essentially an area where you want to be targeting and trading away from or towards. Okay, so this is what we call the 4-pillar approach. And so what's happened over here is that we've had a break of market structure. So if I just make the market structure a little bit more clear, we've had a break of market structure just over here. So we're bearish in terms of our market structure, right? Then we've done our dealing range structural high, dealing range structural low. This is the all-time high on gold. Then from here, we've understood our premium and discount arrays. And so our premium and discount arrays above the 50% area for a premium, below the 50% for a discount. And the final thing is, of course, fair value gaps, which is just over here. The fair value gap is always different from the POI. The POI is one candle before the fair value gap, right? A fair value gap validates a point of interest. And so when it comes to choosing a point of interest on the higher time frame, there's three things you need to look for. The first is the break of market structure, right? You want to see a shift in the market structure. This structural low was broken over here, right? So if I just kind of mark out the structure for people so they understand, this is how I'm looking at it. I'm looking at structural high, structural low, then of course the dealing range high, and then boom, we break structure. We actually broke structure here because we broke with the body, and then we're looking for a pullback to confirm this structural low. So that is step number one. We want to see price breaking with a body. Step number 2 is we are looking for a fair value gap. And step number 3, we want to be in a premium because we're looking for a sell trade in this particular gold swing case study. And so we're looking for a fair value gap that's resting over here. And so with that being said, if we just kind of play price on a little bit, right, what we're looking for is for price to reject this POI. So again, this POI breaks structure, it leaves a fair value gap, and most importantly, it is in the premium, which is where you want to be selling from in the first place. So now if we go down to the 15-minute time frame, right, the 15-minute time frame will give us a higher indication of what to look for. And so what we need to understand from a swing trading perspective is we need to understand a couple of things. We've come into a higher time frame level, right? So this is our higher time frame level. And when you're swing trading, what you need to understand is the power of 3, particularly this power of 3 over here, right? So this very large green candle is actually the weekly candle, right? This is the weekly candle. And so what do you need to understand from a swing trading perspective? So if we just kind of take this over to the side, we want to understand how basically a candle forms, right? So the weekly candle will open somewhere around here. We will see price rally up, rally up, rally up. We will see the high of the week forming ideally in some higher time frame level, higher time frame premium, resistance area, kind of all the same thing. And then from here, we're going to be anticipating the high of the week before trading back down to the weekly opening price. One of the most powerful ways you can trade is understanding the weekly opening price. And so what you need to understand is that when you have a weekly candle like this, if you have a bearish candle like this, your job is to enter inside of the wick and then ride the expansion lower, right? So this is a red candle, right? Well, this is a green candle in this case, but even if you're trading with a weekly green candle, you want to be trading inside of the higher time frame wick and then riding the move lower. And that's exactly how swing trading is done, right? Swing trading all comes down to the weekly power of 3. So it's very important you understand this, right? So if we go back to the charts over here, the weekly power of 3 is the most important thing. The second thing I want to draw traders' attention to is the fact that we have a huge amount of liquidity over here. This is what you can call external range liquidity or trendline liquidity, or whatever you want to call it, right? It's just liquidity. And what gives us extra confirmation that we have previous day lows, Asian range lows, previous day lows, Asian range lows. So we have a huge ton of liquidity that's resting over here in this region. And so from here now, how can we look at this on the 15-minute time frame and understand what's going on? And so what we need to understand straight away as traders is where we are in terms of higher time frame price. So we have come into a higher time frame POI, right? This is a higher time frame premium fair value gap, right? So this is definitely an area we can look for sells, right? Not guaranteed sells, but we need to understand we're coming into a higher time frame area of resistance or an area of supply or a bearish POI, whatever you want to call it, it's all the same thing. Now, once you have that in place, the next thing you're looking for is you want to see the order flow. And we're going to go on to what the order flow actually represents, right? Because the order flow is what holds a lot of traders back, even from a day trading or a swing trading perspective. But order flow is what allows you to read who is in control between the buyers and the sellers. So it's very, very important you understand that. And so now that we come into this POI, what's important to understand again is the daily power of 3. So the daily power of 3 works very similar to the weekly power of 3. So you can see here on the daily time frame, we are massively overextended. London leaves liquidity, Asian range leave liquidity. So we have liquidity resting here, we have liquidity resting here. So the way that I approach the charts from a swing trading perspective is I look at the weekly power of 3 and the daily power of 3. So I can see we're heavily overextended above both of them. This is what gives us the indication to take sells from here. But where a lot of traders go wrong is they don't know which key levels are going to hold, which key levels are not going to hold. And so this is something we're going to go over in this particular video, right? So we can see a large rejection over here. So the question is, what is going on over here? And to answer that, we are now going to go on to order flow. Okay, brilliant. So here we have the order flow, the ATAS platform, right? This is where we can see the same candles. So just to give you some context, this here is a 15-minute time frame. And so this is now the 4-hour time frame. This is the rejection. We're going to be studying the rejection and how you can apply this to your own trading. And so if we go to the ATAS platform, what you want to understand here on the 4-hour time frame is you want to see the candles leading up to the zone, right? So when we lead up to the zone, we don't have to read every candle, and we certainly don't have to read every number. But if we just read kind of these 3 candles over here, what we can see is we can see a huge red bar, a huge green bar over here, a lot of green over here, and a lot of green over here. We even see a decent amount of green coming into the zone, right? So what do these green bars actually mean, right? So what these green bars mean is that there's more aggressive buyers and sellers. So I'm going to be going over 3 examples of how you can interpret the footprint charts and the order flow charts, right? So footprint charts give you the order flow. And so this here over here represents 110 for 484. So that means that there's roughly 4 times as many aggressive buyers than sellers, right? So the market continues to move up. So we can see the market being rewarded at this area, right? We can see the same kind of thing happening over here, where really what we can see is we see 139 for 346. So roughly, what is that, 2.5 times, 3 times as many aggressive buyers as there are sellers. So we can see aggressive buyers hitting the ask, driving price higher. So coming into this area, this kind of 4-hour supply area, we had a ton of aggressive buyers. Same thing over here, right? If we just read this number, we saw a lot of aggressive buyers, right? 71 for 275 resting over here. So we can see significant ask volume compared to the bid, which means that buyers are going in with market prices. Buyers are aggressive. But the question now is, are buyers in control? Now, this is super important to understand. Now, this was a green candle, right? This here was a green candle before we had the large meltdown. But what you need to understand, if we go to the regular candlestick chart, right, this particular area, if we look over here in this region, we saw a huge amount of aggressive buyers, right? So these aggressive buyers were driving the price higher. So what we had over here is we had the ask, which was a lot greater than the bid, right? This means that buyers, let me spell that right. This means that buyers are aggressive, right? Buyers are aggressive in this region, right? Let me just mind my spelling, right? So buyers are aggressive in this region. And so if you see buyers aggressive in this region, but the market breaks below them, you need to understand and ask yourself, what is going on in this region, right? Who is in control? And so the candle, the most interesting I want to kind of bring traders to is this candle. This was a green candle. You can see the candle was green by the body. But when we go into this candle and we look into more detail, what you can understand is that we had a lot of red delta creeping into the zone, right? So we actually had right at the top, if you look right at the top, we had zeros at the top, right? 0 for 8, 0 for 5. And so when you see a 0, there's 2 ways of looking at it. The first way to look at it is that it's an auction that's been wiped out, because markets are basically an auction between buyers and sellers. So when you see a 0 and an 8, for example, that means that there's 0 market participants hitting the bid, and there's 8 market participants hitting the ask, right? So that means that there's no aggressive sellers, right? So when you see a 0 on one end, that means that the auction has been wiped out between buyers and sellers. So the way you want to kind of imagine it in your head is that buyers and sellers have agreed that this is a fair price. It means they're no longer interested in trading at that price. And also you want to another way of looking at it is in terms of volume, right? So volume corresponds to the bid plus the ask. And so when the volume gets lower, obviously that means when you see a 0, the volume is decreasing. And so you want to ask yourself, if the markets are moving higher, but the volume is decreasing, that means that buyers and sellers together are no longer interested in those higher prices. Because if they're no longer interested, what that means is that the ask and the bid naturally decrease, which means the markets don't want to trade at that price, right? The buyers and sellers do not agree that this is a fair price. So you know something is going to happen in this region, right? So you know the markets can either head higher or lower. But we know that we're significantly above the daily opening price, we're above the weekly opening price, and we can see aggressive buyers in this area. And so the next question is, when you see aggressive buyers in a key level, but the market significantly breaks lower, because we can see over here the market breaks lower. And so what's interesting, if we kind of bring the footprint chart side by side to the regular candlestick charts, if we just kind of do that now, what was happening over here is the following. Let's kind of bring this up together. So what was going on here essentially is that we saw a lot of aggressive buyers heading up to the zone, right? Aggressive buyers, aggressive buyers, aggressive buyers. The same thing over here, lots of aggressive buyers in this zone, right? What's even more interesting is that this rejection over here on the 15-minute time frame was very, very nicely summed up by this red candle over here. But this red candle was interesting because if you look right at the top of the red candle, right, there were actually a lot of aggressive buyers over here. There was more buyers, aggressive buyers than aggressive sellers, right? So 4 for 58, right? So this was the final rejection. So this rejection, 4 for 58 and 0 for 3, that is what you see just over here where I put order flow. So this is telling you that there's more aggressive buyers and sellers, and there were lots of aggressive buyers over here. And so when we go back to our candlestick chart, right, what you can see is that all these aggressive buyers were kind of shaken out with this, I guess, change of character, internal boss, whatever you want to call it. So this here is what gives you the indication. So when you're swing trading, I'm less kind of accurate with the exact order block, the exact fair value gap, the exact breaker entry, whatever you want to call it. It's more about understanding direction and who's in control of the markets. Now, with that being said, I know a couple of things have happened over here. I know that buyers are aggressive, but buyers have failed. Because if these buyers had been successful, they would have broken above this zone, right? So we know that this zone is strong. And so what do we mean by a strong zone, right? What does that actually mean? A strong zone or a strong fair value gap means that there's passive sellers, right? So you want to understand this. If I kind of take this over to the side, if you have a key level like this, right? Let's say you have price coming into a key level, and you see a lot of buyers coming into the area, buyers coming into the area. You see lots of buyers coming into the area, but they struggle to break above price, right? They really struggle to break above. They actually break below, which is what we saw over here. They break below, right? So all these buyers have failed. And so if buyers fail, that means by default, even from a common sense perspective, sellers are in control. So from a technical perspective, what we can say about gold from a swing trading perspective, if we just go up to the 4-hour time frame, right? If we just kind of clear this up a little bit, what we can see is this POI is supported by sellers, right? Passive sellers are in control because aggressive buyers fail. And that's something which, of course, the ATAS platform can tell us, right? So this little rejection over here corresponds to this over here, right? 4 for 58, right? So 58 aggressive buyers, and the market heavily broke below the zone, right? We can see that with the huge red candle. And so when we go back to the 15-minute time frame now, the 15-minute time frame gives us clear runway for entry, right? Clear runway for entry basically means this, right? We can enter just off the breaker structure over here. You can enter kind of anywhere around this region, and you can have your stop loss if you want all the way at the zone, or you can have it kind of just below the zone over here. Now, this trade did have decent runway. So why did this trade have decent runway for a swing trade? Even a 1 to 2 on this trade would have been good. The reason for that is if we just kind of go back to where we were at the start, we started with the weekly power of 3. The weekly opening price is all the way down here, and we have a huge amount of trend line liquidity. And so we can target a couple of areas. We can target the Asian range low, because that's going to be the first kind of logical target, right? That's going to be our first logical target, because if price takes out the Asian range high, we know from experience price will come and take out the Asian range low afterwards. So price takes out the Asian range high. We want to be targeting the Asian range low with full volume. And so that's kind of what happens here during the Asian session, right? So we kind of hit our first target later on in the Asian session. So if we just continue to play price on a little bit, we can see eventually price melting in our overall direction, right? So again, the weekly opening price is what can keep you inside of the trade, right? So we understand we're just aiming towards the weekly opening price. And so what do I want traders to take away from this video, right? Why was this important, right? So it's not so much about the risk to reward or the targets or anything like that. What you need to understand is that the market will move down when aggressive buyers fail. And that's exactly what happened over here. And so if I kind of clear up the charts a little bit again, this was a swing trade you could have taken on gold. And so what makes this swing trade valid, once again, is the order flow. And I want traders to understand, when you see aggressive buyers coming into the zone, but the market fails to move down, that means that sellers are in control, right? So we can see buyers failing over here, buyers failed over here, and this is what leads to the rejection lower. As for targets, and as for choosing the right target, your job is to simply target a couple of areas, right? You want to target the Asian range lows. you want to be targeting, you want to be targeting areas of fair value gaps. So we see a lot of fair value gaps over here, inefficiencies and fair value gaps. So this is where you want to be targeting in your overall analysis, right? So that's kind of the first trade I wanted us to go over. Now, in terms of the second trade, right, let's go over another trade as well. Another kind of, I guess, a swing trade you could have taken on gold, a more recent kind of swing trade, right? So again, we're going to go through it a little bit quicker this time, but we're going to be analyzing our structure. Now, in this case, right, what you're looking for in terms of market structure is this, right? You see a structural high, you see a structural low, you see price giving a structural high, low, but we didn't actually see price come into this area, right? So we saw price give us somewhat of a dealing range over here. Now, this was a dealing range that I was looking for, right? This was a dealing range, and we had a kind of bounce off a fair value gap over here, right? Not the highest probability trade, right? This is not the highest probability trade. The reason why is because this POI, you can see, is not actually below the 50% area. It's at an equilibrium, which doesn't mean you can't trade it. You just need extra confirmation. And so we had a POI all the way down here, but this POI was pretty low in the leg, so I wouldn't necessarily wait for a POI like this because it was significantly below the range. But if we go now and understand what was going on, it's a similar kind of concept, right? So I don't trade gold myself, but I've had lots of questions on how to trade rejections, how to use order flow, how to kind of swing trade gold or swing trade ES or NQ. It's all the same principles, right? What you need to understand again, the weekly opening price was all the way up here, right? Price took out the Asian range low, and we had a huge rejection on a Thursday going here, right? So if the market moves down, right? So we had Monday move down, Tuesday move down, Wednesday move down, Thursday into a key level way below the weekly opening price is likely to give the rejection. And that's what we saw over here, right? So this here was the rejection. So again, what's going on over here, right? So over here is the opposite of the sell trade. So we see a lot of aggressive sellers, right? So here you're going to see the bid be a lot bigger than the ask, right? The bid is going to be a lot bigger than the ask. So what that means is that aggressive sellers are present, right? But did those aggressive sellers get rewarded? If those aggressive sellers got rewarded, we would have seen price do this. We would have seen price break below this level, right? We would have seen price break, if I move that, we would have seen price break below the level. So we would have seen this, we would have seen continued lower prices, right? But we were able to hold this area and then move to the upside. And so if you can understand where buyers and sellers are aggressive, swing trading becomes very, very simple, right? So depending on how you traded this, you could have taken a kind of sell trade anywhere here, kind of off this kind of fair value gap over here, stop loss below the level, and you simply want to be targeting, again, where are the targets, right? Where do you target as a trader? So Asian range high, right? Very important. We have another Asian range high, right? And you just basically target the weekly opening price. So again, first target over here, second target over here, right? This is how you kind of swing trade. You swing trade by understanding points of interest, higher time frame fair value gaps, and you need to know, right? And I will keep hammering this home. You need to understand what's going on over here between buyers and sellers, right? So again, the ATAS platform is what I use. The ATAS platform will give you everything you need, right? So the ATAS platform, it gives you the candlestick charts, but it also kind of tells you what's going on over here. So if you kind of look at this again, you see how we had this fair value gap over here. Look at this rejection, right? This is now 15th of May, right? Look at this rejection. What was going on, right? What was going on inside of the fair value gap? So again, red candle followed by a green candle, right? But what gives you confidence to take trades is you need to know that sellers are failing. Because if sellers have failed, that means buyers are in control. So you have a 50% chance of getting it right if you understand what's going on. So in fact, this price action over here where I've circled corresponds to this price action over here. So if you read the actual delta in this case, right, delta just refers to the ask minus the bid. Here we had a ton of negative delta, right? In fact, we had 487 for 102. So we had roughly almost 5 times as many aggressive sellers than buyers, right? Same thing over here, 480 for 74. Significantly more aggressive sellers than aggressive buyers, right? And then from here, we had price kind of shoot up. And so what you need to know from here is that we've seen sellers, in this case, fail. Sellers failed around this region. We're significantly below the weekly opening price. So if you wanted to, you can even enter somewhere up here, right? If you're not confident, right? But you want to try and enter as close as you can to the level. You can have a safe stop loss around here because you know sellers have failed. The zone is strong. Passive buyers are in control, and that's why the market moves higher, right? So one more time. You've seen a lot of aggressive sellers, right? A lot of aggressive sellers. This means that the bid is a lot greater than the ask. That means that passive buyers are in control, right? And it's all about seeing who's in control. Who's in control in this zone? Buyers. Why are buyers in control? Because aggressive sellers fail. How do you know aggressive sellers fail? Well, aggressive sellers fail because, boom, that's how I know, because I can read the numbers. So if you can read the numbers, you can read order flow. If you can read order flow, you can know who's in control. And if you know who's in control, you can swing trade successfully. And so that's what I wanted to go over in this video. So if you like this video, give it a like, give it a thumbs up. And if you are interested in a free one-to-one session where we can go over this in more detail, use the concepts to build a plan that works for you, just comment below and I'll happily help you out.